Right, so we need to understand the syllabus for FRM part 1. So basically, the couple of, firstly you need to know the syllabus absolutely very thoroughly well beforehand, before you begin preparation, because you need to understand the synergy, you need to understand the entire flow of things. In the sense that if you do not have a holistic picture as to what you're going to study, it becomes a little difficult to understand, because you have to understand from the point of view of there will be related chapters, there will be connections between subjects, there will be interdependencies. For example, I need to know probability before I'm able to study portfolio, for example. I need to understand time value of money before I study fixed income, for example. So you need to have an understanding as to what topic is what and how they are related with each other. So that understanding has to be there. Even when you're attempting questions, you can't just study one thing singularly, right? You have to understand the relationships. So for those who are planning to, those who are attempting exam, you have to make sure that before you start studying for the exam, you have a very holistic understanding about the syllabus, because then you'll be able to understand, once you have the macro picture, then you'll be able to understand what part you're studying and how it is fitting in the bigger picture of things. Second, for those who are confused in terms of understanding whether to go for an FRM certification or not, so for them I generally ask them to watch the syllabus part and the scope part, because based on the syllabus, what are you going to study, that's the most important thing you need to note before you begin preparation, or before you decide whether to go for or not to go for something, whether it's suitable for your current profile, current work ex, or where you're headed towards, and the scope of the designation in terms of industry, application areas where you'll be able to apply this knowledge, right? So you have to understand, you have to be very thorough with the syllabus, because I've seen students, professionals skipping this part and not bothering about what the whole syllabus is all about, right? The next thing is with respect to syllabus. So when we are looking at 2020, basically we've seen that the institute has launched its own material from the year 2020 onwards. So before 2020, institute's material was not included when students used to register, but now when a student registers for the FRM part 1 or part 2 exam, they have the e-books of the institute provided when you are registering. Right? If you need to know how to access the material and everything, you will WhatsApp the coordinator. So the number will be given in the comment section, and you students who are in the class right now, you anyways have a number. So how to access the material if you're unable to, you can see. Otherwise it's simple. Once you register for the FRM exam on the institute's website, you can access the material. So the institute has launched its own material from the year 2020, and that material is decent. So I have gone through the material, I've browsed through the material. The material seems to be good. I'll explain the material and everything in the next part. I need to discuss the syllabus part. Another thing is that when you're looking at the syllabus curriculum changes, if I start analyzing the curriculum from the year 2012, so I would see a significant change that has happened, additions and modifications over the years. From the year 2017, 18 and 19, the curriculum was 95%, 98% more or less similar. 2019 to 2020, if you're seeing, there has been major upgrades in terms of syllabus, major changes in terms of syllabus. Now the content or the subject matter is going to be almost 80% same, 85% rather, not even 85% same. There are minor additions to places. There is a lot of reorganization, of rearrangement that has been done. And personally, I see that the syllabus has improved for the better. With respect to the material, from where to study, where to prepare, I'll talk about it in the next part. Right now, I just want to discuss the syllabus with you. So understanding the syllabus is important, and while I go through it, for some students, I'll keep on talking about, this has changed, that has changed. It may not be relevant to the first time for those who are starting preparation, but I'll keep on mentioning a little bit here and there, or rather I'll actually stick to the syllabus only. So anyways, the changes you don't need to bother about. Those who are starting, those who are trying to understand the syllabus, I'll just keep on mentioning. So as we all know, when you're looking at the part 1 curriculum, we have 4 subjects. One is a foundation of risk management. The second one is with respect to quants. The third one is the financial markets and products, and the fourth one is valuation and risk models and valuation methodologies and all. So these are the 4 subjects you have. You already know the weightage is 20%, 20%, 30%, 30%. So out of 100 MCQs, you'll have 20, 20 from foundation and quants, 30 and 30 from financial markets and products, and valuation methodology, valuation book, the 4th book. When you're looking at the the questions and all, I have discussed the exams in detail in the next in a different portion, wherein I've discussed about the MCQs and the level of exam and the difficulty and all that. The questions are relatively spread out well. Again, I am not an exam paper setter. I have no idea about the exam. I have nothing to do with the institute. I'm giving a very clear disclaimer. Please do not, take my word to be anything coming from the institute. So I have got nothing to do with the exam preparation, exam setting up and all of that. So don't misconstrue what I'm saying, right? It's so it's important not to miscommunicate and to be as transparent as possible. So anyways, coming back to the syllabus part of it. So foundations, broadly, if you will see the first book, it is going to be more of an introduction towards what risk is all about. It might be from a theoretical perspective, but when we study, you will find that questions are even more subjective and more difficult from the non-numerical portions. So therefore, even if I'm studying something like a risk management, what is risk management and all, you have to study really thoroughly. So there is going to be a little bit of theory over here. There is a good context of the 2007-8 crisis that happened. So 2007-9 crisis that began, the recessionary phase that we saw with the housing mortgage loans being defaulted and all of that in the US and the entire global meltdown that we had noticed. So how did that happen? Why did that happen? That part we are going to study. And certain basic terms with respect to that we need to understand. There is going to be a portion on financial disasters over here. I'm going to discuss every chapter in detail. I'm just giving you a broad overview of all the 4 subjects first. Then financial disasters. So say for example, what are the things that went wrong? Like in India, if you're seeing, you have the PMC bank, you have Karvi issue that happened, you have Nirav Modi, Mehul Choksi that happened. And so you have so many wrongdoings that we have seen. So say for example, what went wrong with Punjab National Bank when they gave out more loans to Nirav Modi. It is important to learn from that, because so as not to repeat that in the future. So that's why it becomes a little important to study what are the issues that we have faced on a global level. So I'll give you the examples we are going to discuss. And the numerical portion in the first book is going to be with respect to portfolio. So there are going to be a couple of readings which is going to be focusing on the portfolio part. I'll explain. Now, obviously, in order to understand portfolio, you need to have completed basics of statistics and probability, which is covered in quants. So now when you're looking at quants, again, students have an issue in terms of, that if I'm good at maths, I've not been good at maths and all. So that is a query that students have. First of all, you have to understand you're not going to be solving difficult mathematical questions. The objective over here is going to be with respect to application. Second, we do not have geometry, trigonometry, calculus over here. What we are going to be studying primarily is 3 parts. One is money related calculations. So when you've seen simple interest, compound interest, or annuity in school, so we are going to study time value of money, a little extension of that. We're going to study probability, because whenever you want to get into any kind of decision making, you need to understand probability well. So the second part is probability. I'll explain again, I'll get into the details. And the third, the most important chunk, 70% of quants is going to be, 70-80% of quants is going to be statistics. Because anytime you want to take any kind of decisions for the future, any decision making you do, you have to analyze past data. So it has to be data analysis. So when you're looking at statistics, so even if you guys are looking at machine learning and data science and all those things, that is a much higher level of software oriented level of statistics in a way, if I could say so. So you're looking at the statistics portion in quants, which is going to be relatively extensive. And a lot of people compare the CFA curriculum with the FRM curriculum. So CFA level 1 and 2 quants combined is going to be over here in this quants over here. And of course, it's going to be different. It's not the same. But what I'm saying is there are portions of CFA level 2 quants which is here, and level 1 portion of quants which is here as well. Anyways, quants is something, again, I'll get into the details. I'll tell you all the chapters and all. But it is not that if you do not have 11 and 12 maths, if you did not have maths in 11 and 12, of course, it's going to be relatively difficult for you. You'll have to work a little harder. You'll have to study a little harder. But again, it is statistics, it is probability, and it is time value of money. That is your money related calculation. Right, so that is what we're going to be doing in quants. So you don't have to worry as such. For those again who are weak in mathematics and have scared of mathematics, you'll have to put in a little extra effort. Otherwise, it's not going to be an issue. When we're looking at the financial markets and products, so basically the curriculum over here in these 2 subjects are going to be little overlapping. So we have primarily derivatives and fixed income. That is what we're going to be looking at. These 2 subjects are going to be almost 60-70% numerical. 70%, 60, 70, yeah, I can say around 70% numerical. 30% conceptual. So even when I'm not looking at non-numerical, all I'm saying is that there are no sums on it as such. But when questions turn up on these areas also, it is not going to be a direct question, define that, state this, define that, state that, give two reasons and all of that. Of course it cannot be, it's MCQ. And even if in the MCQ questions, even if it is non-numerical, the questions will be absolutely conceptual. So you have to be extremely thorough with respect to that. Right, so these two books are going to be covering primarily 50% of both the books combined is going to be derivatives, 50 to 60%, and a good chunk is on fixed income. So derivatives I had, so basically for example, if I were to define derivatives in a very easy and a quick manner, so say suppose I'm scared that if I'm dead, who's going to take care of me? So what I do is I buy a life insurance. Who's going to take care of my family? So I buy a life insurance. If I'm scared that if I'm going to fall ill, who's going to take care of my medical bills and all? So we buy health insurance. But there are a lot of risks involved when you're doing business. Say for example, an exporting or an importing company is there. Now what happens to their exchange rate fluctuations? How are their revenue, profits, etc. going to get impacted? So how do we manage that risk? Say for example, you're a tire manufacturing company. Now if the prices of raw material, that is your rubber, fluctuates, then how do you, there is a commodity price risk over here. So how do you manage that risk? If the interest rates are going up or down, is moving in a different direction, then how do the banks and all going to be able to tackle risk? So that is going to be your interest rate risk part, right? So how do you manage different risks? Of course, for the banking organization, the risk becomes even more pronounced, as in more important. But even other organizations, when you're looking at a real estate company, for example, so these guys do have a lot of susceptibility or they're very largely affected by the changes in interest rates. Why? Because of course they do take a good amount of loan. There is a lot of debt in their balance sheets and their products are not fast moving. They take a good amount of years in order to construct, and realize the amount of money for the project they have completed. So when you're looking at a real estate industry, these guys will be having a lot of sensitivity towards the interest rate movement. So how do we manage risk? So that part, the managing risk, comes from derivative transactions. So of course I'll take almost like a couple of hours to introduce derivatives when we start studying derivatives, but that is primarily 50% of the curriculum around these two books is going to be with respect to derivatives. So you understand, and fixed income, you understand all the interest related calculation. When we invest money in the bonds and debentures and all of that, that is all a part of your interest rate related calculations. And say for example, we'll do a theory chapter over here with respect to country risk. Now today when you're looking at the global scenario with the US-China trade war, with Iran issues, and with global oil issues, and Russia and China and Korea and US and India, and all the powers being relatively on the bolder side and not so diplomatic, but more in terms of there is more concentration of power, if you will see, and the way everything is going on, country risk becomes very important. Today anything happens in any country, a Brexit happens, a US-China trade war happens, in Iran something happens, and the entire global economy is affected because of that. And we saw in 2007-8 how the US crisis led to the global meltdown. You're understanding the idea. So country risk is something that we need to study probably in the valuation subject. So you're understanding the broad area in which we are going to be studying. Let's get into the details of every single chapter to understand the entire curriculum at large, right? The first one, so when I'm looking at the foundations, I'm not going to write all the chapters' name. So the first one we are looking at is the building blocks of risk management. So over here we talk about what is risk all about and what are the different types of risk. Now types of risk may not be restricted to market risk and credit risk and all. So market risk, if prices are moving, then how is my portfolio profit or loss going to get affected? Or if say for example someone defaults on their loan, so someone has borrowed money and he does not pay me back, that is going to be a part of your credit risk. There is a reputation risk also. So say for example when the Nestle Maggi thing happened, where the lead content was found in Maggi, so that leads to a reputation risk for a company. If a government comes up with a regulation, there could be a regulatory risk. If the government is going to ban cars with 1000 or 2000 cc engines and all in Delhi as it happens, so that leads to a regulatory risk. So we need to understand the risk and the risk management process, and that is what we're going, and the interactions between risk, because what we have also seen is there is a certain level of contagion. There is a word called contagion, which comes from the word contagious, that how does risk transfer from one to the other. So because this defaults over here, this guy defaults on this, because India is facing issues and this country starts facing issue, that leads to another one, and it spreads like a disease, like a contagious disease, and we call it contagion. And you know how diversification, I'm finding it a little difficult to communicate all these things right now because you've not studied, but you know how the relationships between risk is going to magnify the impact of the entire risk or the issue. So that is what we need to understand when we're looking at the basics. The first reading is going to be with respect to the basics of building blocks of risk management. Second, we get into how do financial firms are managing risk at the moment. So here we are also going to be discussing in terms of what different terms like risk appetite. So what is my risk appetite? What amount of risk I can take? So I'll give you an easier example. So what kind of risk is Mr. Ratan Tata can take, and what kind of risk I can take in my portfolio is going to be very, very different. My risk appetite is going to be almost negligible as compared to what amount of risk he can take. So risk appetite when you're looking at a company. So what is the amount of risk a company can take? That will depend on the business model, the profitability of the company, etc. So how much risk you can take, what kind of risks you can take, how should the risk management process be in your company? So that is what we are going to discuss. Relatively easier on the non-numerical side of the reading. Then the governance of risk management. Now, as I was mentioning the example with respect to the Punjab National Bank. So how do you manage, how do you govern risk? An example could be that say suppose a loan bill above a particular level of amount needs to be approved by so and so committee. So I have put in a so and so committee that if one entity or if one company is going to be given a loan of amount of more than this much, then an approval needs to be coming from here. So if you have these kind of policies in place, it is going to reduce the amount of risk, because you will not end up giving loans like PMC Bank gave to HDIL. Right, so we need to control the amount of risk that is there. So what kind of governance, what kind of structure you'll put in your company? How would you make sure that the entire governance of the banking organization of the financial institution is in such a manner wherein the risks are not getting amplified, and rather there is a proper governance and people are not misutilizing the funds and incorrectly managing the banking organization. Just the way, say for example, an Infosys or a TCS kind of a company, which is an IT company, will be having a chief technology officer. If you're looking at a fund or an investment company, they will be having a chief investment officer. Similarly, when you're looking at financial institution and banking organizations, they are supposed to be having a chief risk officer. So having a CRO, what will be the powers and duties of CRO? How should you be positioning them in the broader frame of organization? So all those things we study in the governance of risk management. Comfortable? In the next reading, we have credit risk transfer mechanism. So basically, this is going to be a very interesting chapter. Why? Because again, I'll tell you the relationships. So the objective also in terms of discussing the syllabus is to understand the relationships between different topics. So here we have something called the mortgage-backed security, and there is a corporate bond also. I'll not discuss that right now. And in this one, we have this reading credit risk transfer. So if you guys, you know, what you could do is, if you guys have the have access to the index page of your textbooks, if you are carrying the textbooks, and if you have the index page, you can do a little bit of putting up some brackets and all. So when you're looking at the first three readings, as I told you, the building blocks and how do firms manage financial risk and governance. So those three are going to be more of theory and risk introduction. So if you want, you can group them, it's easier. Maybe, you know, syllabus, whenever they change the syllabus, maybe one or two chapters plus or minus happens, that's fine. So I'm trying to give you the relationships between different chapters. Then you have the credit risk transfer mechanism. And there's one more, just a second. And there is a 2007-9 crisis. The name of the chapter might be a little long. They might be changing the names of the chapter. The Anatomy of the Great Financial Crisis 2007-9. So basically these three chapters are going to be relatively interrelated. These three readings are going to be relatively interrelated in the sense that the 2007-9 crisis happened because of the housing market collapse. That was one of the very important reasons why the 2007-9 crisis happened in the US. Now, the securities that were used at that point of time was mortgage-backed securities. So you need to understand mortgage-backed securities as well. And the other different products that was used, the securitization process, these securities are created by something called a securitization process, which is explained over here. So these three chapters are going to be a little related. So when I give out the order of study for you, to you guys, that this is the order in which you're going to be studying. So the chapters are not going to be studied from chapter 1 to chapter 60 or 70 or whatever. You're not going to be studying the chapters in an exact same order, in a sequential manner, but rather you'll be studying the chapters in the manner in which I ask you to, because there will be certain relationships between certain chapters which needs to be looked into. So when we are going to be studying, you'll be studying the credit risk transfer, 2007-9 crisis and MBS more or less together. In fact, if you want to get a basic idea about these three readings, what you can do is in the YouTube playlist key concepts, there is a reading, there is a video on, there is a lecture on asset securitization. So you watch the asset securitization, you'll have a fair understanding of what led to the 2007-9 crisis, what ABS, MBS, mortgage-backed securities and all are, and what is the securitization process that has been discussed over here. Tell me, are you understanding? And credit risk transfer. Now, when you're looking at risk management, you need to understand credit risk transfer, your risk management. And also, actually, I should have mentioned this earlier. When you're looking at risk management, it is not removing risk. Because if you do not take risk, how do you plan to earn money? If you take risk, you'll be able to earn profits. If you want to earn returns, you'll have to take risk. But what risk to take? What amount of risk to take? Which risk to take? Which risk not to take? For example, a bank will be taking risk about interest rates, but bank is not going to take fire risk. They will be having fire insurance in place. But an insurance company is the one, if there is a fire in your godown or in your factory or in your office building, the fire insurance company will have to make the payment. So technically the risk of fire is there, but you will not have to bear the damages. The insurance company has to bear the damages. So by taking an insurance, what you've done is you've transferred the risk. The risk is there in the economy. If there is a fire, there is a possibility of fire. But if the fire is there, you are not going to be suffering the risk. It's the insurance company which will be making payments for the damages. Risk transfer. Are you understanding risk transfer? Of course, we are not going to be just discussing life insurance and all, because that is going to be looking at risk transfer in terms of me as a person. We are looking at more of your financial risk management here. So it's important to understand the broader picture of things. Are you understanding why I'm making you go through the entire syllabus first before starting off with the curriculum? Because you need to understand the broader frame of things before you're moving forward with the curriculum. So in credit risk transfer, again, you'll be understanding quite a few things, including securitization process and all, and these three are going to be little related. So you can say, for example, in your index, securitization, securitization, securitization. They're all three related to the securitization process. So if you want, you can write that down in the index, on the index page itself, if you're carrying your textbooks. Then when we are looking at it, so this is there in the first book. This is there in the first book, not yet in the second book. But after credit risk transfer, we have two readings. One is modern portfolio theory and capital asset pricing model, and the other one is your arbitrage pricing theory and multi-factor. And this is capital asset pricing model. Now when you're looking at this chapter, you can bracket this together, and this entire session is is with respect to your portfolio part. So when you're looking at modern portfolio theory, capital asset pricing model is an extension of this. Then you're looking at the arbitrage pricing theory, multi-factor pricing model is an extension of this one. This entire portion is your portfolio theory. What do you understand by a portfolio? So say, for example, when I'm grouping multiple stocks together. So say, suppose I'm talking about my portfolio. My portfolio is comprising of the mutual funds that I own, the gold that I own, the house that I live in, the stocks that I have purchased, the fixed deposits, PF account that I have. So all the things, all the assets and all that I possess, that is all a part of my portfolio. Now when you're looking at portfolio, don't just think from an individual's point of view. A portfolio could be thought of from the perspective of a bank. Now think about it. What is the basic functioning of a bank? When you're looking at the balance sheet of a bank, the basic idea of a bank is to accept deposits from people. That is the liability part. The bank borrows money from people, or people deposit money in the bank at, let's say, a rate of 4% savings account, 0% current account. There will be a higher rate of interest for fixed deposit account. And I'm doing it from an Indian point of view, therefore my liabilities are on this side and asset is on this side. The US is going to be following in the opposite format. When I'm looking at the assets, banks, major chunk of asset of the bank is to give out loans to people at the rate of 8%, 9% or so. The difference is what the bank is going to be making. That is your net interest margin. Ultimately, the objective, the business model of the bank is take loan at a cheaper rate, give out loans at a higher rate, and the difference is what you want to make. That is what the bank's business model is, right? And when we are going to be studying the readings and doing the chapters and all, I'll keep on giving you books, names and all in the middle, and it is your responsibility to note down. If I've talked about a video or a book or an app or something, use that, download that and learn on that. Like for example, when I'll discuss banks, I'll ask you to go through the HDFC Bank part of the Unusual Billionaires book. So Unusual Billionaires has been written by a portfolio manager. In that there are 7 stocks that have been covered. One is HDFC Bank and the second is Axis Bank. So when we study the bank's related chapters, readings, I would want you to go through that particular section of Unusual Billionaires. You have to have a practical understanding, right? So we'll have to study in that manner. In fact, when I do mortgage-backed securities, after completing this chapter, I'm going to ask you to watch a movie called Big Short, The Big Short. Don't watch it right now, you'll have a problem understanding the movie, because it's totally based on the securitization and the 2007-9 crisis. So once you understood asset securitization and once you've done this reading, the 7-9 crisis, please make it a point that you go and watch that movie, The Big Short. Tell me, are you guys understanding the basic so far? So when you're looking at the bank's business model, so the bank's portfolio is going to be comprising of all the loans that it has given. Now it is important that the bank does not give out 70% or 80% of the total amount it has to a steel industry. Because what if the steel industry is facing a downturn? In that situation, what happens? In that situation, the bank is going to be suffering a huge amount of loss. So that is why I would want to have my loan portfolio diversified. You give thoda loan, give a little bit of loan to this sector, give a little bit of loan to this sector. So you'd want to give it to different sectors. And also, do not give a huge amount of loan to one particular company, because if there is any issue in that particular company, you will end up making a huge amount of loss, right? That is why when a company wants to needs a big loan, a consortium of banks, a syndicate of banks comes together to give them a loan to give that big amount of loans. There is a lead bank where there are multiple banks who are going to come together in order to give a loan amount. Anyways, the portfolio that we are going to be studying is not going to be with respect to a bank's portfolio. We are going to be studying portfolio in a normal way. When you put together all the stocks, how do you calculate return, how do you calculate risk? It's one of the most interesting subjects. So portfolio, derivatives and fixed income. These are the most interesting subjects in finance curriculum that you find. So that is going to be your modern portfolio theory, capital asset. This entire part, these 2 readings are going to be with respect to your portfolio portion. Comfortable? Easy? The next reading we have is on data. So I'm just giving you the basic point of the chapter. The full name is Principles for Effective Data Aggregation and Risk Reporting. Now, why does data become important? So when we are discussing this, when we will do this reading, I'll be talking about the Cambridge Analytica with respect to Facebook, for example. So today when you're seeing data is a new oil, people say, and data has become extremely important. We understand that. There are so many businesses which are solely thriving on the basis of data. Their entire business model, for example, Google is based on data. You are the raw material for Google to be earning profits, right? Now, so how do we make sure, how do we put together the data? For example, can you do a 15 kilometers plus 30 liters? You can't do that. So basically, when I'm putting together data, when I'm collecting data, what should be the attributes of data? There should be a certain way in which I'll be able to put together the data, and in order to do analysis on that. Say for example, banks. Nowadays we see so many times that on an app or something, there is this news coming out that so and so's data has been leaked, and in shorts you keep on hearing, this data was leaked over here, this company's data got hacked and all. So data has become so important. So how do you maintain that integrity of data today is very, very important. Although we are going to be doing the reading which is going to be relatively theoretical, but the way we'll have to understand is going to be absolutely conceptual. And in easy chapters, you might be expecting difficult questions. So there is no question of selective studying. There is no question of taking anything, any topic, any particular reading or chapter lightly. You can't do that, right? Then we move into the expected enterprise risk management part. So ERM again is going to be, this is going to be again theory. So the first 3 chapters were relatively basic theory. This is also going to be theory again. I'm saying basic theory in terms of understanding is going to be easy. but it is going to be very practical. So you can't, again, you have to have the understanding in terms of application, because questions will not be direct. So you have to again understand from the point of view of application. So when you're looking at the ERM, that is enterprise-wide risk management. Now say for example, you're looking at a bank. A bank has got a credit card department, a forex department, a treasury department, a trading department. Now all the verticals cannot be doing their risk management separately. Say for example, there's a credit card department and there is a foreign exchange department. Now the credit card department has, we all have made the institute's fees payment, and because of that, the bank has a lot of dollars to pay. Now say suppose, for example, in the forex department, there are a lot of exporters. So the bank has received a lot of dollars from outside, and the exporters are converting the dollars into rupees and taking rupees from bank. Now don't you think when I'm looking at both the departments, the credit card department has a lot of dollars to pay and the forex department has a lot of dollars to receive, they're kind of cancelling out each other? So don't you think I should study the risk management as an organization as a whole and not manage risk of individual department? Because this department will try to manage risk of dollar payment, this department will try to manage risk of dollar receivable, but if you combine and see the two departments, they've cancelled out each other's risk automatically. And also, in order to understand the risk from a very, very holistic point of view, you have to understand in 2007-9, in 2008 September, we saw Lehman Brothers going bankrupt. It was the second largest investment bank of the United States. The United States government was not able to bail out that bank. Just imagine the scale of losses that people must have suffered, the amount of risk the bank was taking, and it was more of a global risk because a lot of money from Europe was already invested in the US and the US denominated banks, US domicile banks. Now when you're looking at the risk of things, don't you think that we need to look at the risk from a holistic perspective and not just an individual department or an individual stock or an individual something? We need to look at risk from a very, very broad perspective. Tell me, are you guys following this? Everybody understanding this? So that is going to be a part of your enterprise-wide risk management. Then we are going to study something called the financial disasters, as I was telling you. Again, you can put this as theory. This is also going to be a part of your theory. But it is not the basic theory part, it is more about your history. Now there have been a lot of case studies. There are a couple of case studies that have been added over here. So for this particular reading, you have to think from the point of view of case studies in a way. So let's say for example, we'll have 10 case studies given over here. The defaults or the bankruptcy cases, or not the bankruptcy but the fraud cases, rogue trader cases, etc. that might have happened earlier. So and so employee of this company did so and so trade which was not authorized. He trades millions and millions of dollars, which ended up making which led to the bank incurring a huge amount of loss. So how does a bank prevent that? Do you know there are infidelity insurances also available? If your employee has gone rogue, if your employee is doing wrong trades and has gone against it, gone against the guidelines and everything, and he incurs a huge amount of loss, you can take insurance for that also. So those things are also covered over here when we are looking at the financial disasters part. Here, when we do the chapter, I'll explain to you in detail, obviously. I'll tell you exactly what to learn. So it's the case studies that you'll have to do, and each case study is going to tell you, as in each situation, each banking, each history, each incident from the financial history is going to tell you that these were the mistakes this bank made or this financial institution made. These were the loopholes. This is what should have been done in order to prevent it. So next time onwards, you please make sure that you don't make this mistake. And these case studies have been classified under different risks and all, model risk or rogue trading or financial engineering or cyber risk where your account is getting hacked or something. So what are the loopholes we had, where we made those mistakes, what mistakes we have made, and how not to repeat those mistakes in the future becomes very important over here. Tell me, are you understanding the idea? That is going to be with respect to your financial disasters. And anatomy of crisis I've already mentioned, and then there is a reading, GARP Code of Conduct. This is basically a reading on ethics, extremely important. Again, as I told you, you can't do any kind of selective studying, so I would be expecting a question on this, I would be expecting a question on this, I would be expecting a question on this. Out of this and this, I'll be expecting quite a few questions. The first 3 chapters is like a bracket of 3 theory chapters. I would be expecting a couple of questions. So you have to understand the pockets of the syllabus. The first 3 chapters are relatively similar. It's one group of chapters. These 3 chapters are a group of chapters in a way. So you have to understand the curriculum that way. GAP, Code of Conduct, Financial Disasters are singular chapters. They're not related to any other chapter as such. But when you're looking at GAP, Code of Conduct, for example, ethics becomes very important in financial history. Now, we cannot allow a Lehman Brothers again to repeat itself, a Lehman Brothers kind of an incident to repeat itself. There was a lot of unethical activities that was done during the time of, because of that led to the Lehman Brothers going bankrupt. Obviously, if things are going wrong in the economy, there has to be, there generally has to be something that has also gone wrong. So basically what was happening was that when you study securitization, you'll understand people who were not able to afford loans, the banks and all were giving loans to those guys also. And those securities which were not supposed to be rated A-rated or AA rated, or those were not good quality, there were rating agencies which were saying that no, this is a good quality bond, you can buy, you can invest in this. I know you've not done the terms rating agencies and bonds and everything, it's fine, we'll get to it. But say for example, there is an agency which is saying that yes, this is a good investment, the one that rates, provides ratings and all. They were incorrectly doing, unethically doing all these activities. So when these kind of unethical activities and all started happening, of course it created a bubble. And that bubble burst and the entire economy was pushed towards your a recessionary phase, and that too globally, because again, it's a very globalized world that we live in. Tell me, are you understanding this area? I'm sorry, my voice is a little problematic today, but and I'm going a little slow today because of the voice. Then we move to the next textbook, that is your quants. So this part you understood? You have an idea, you bracketed or written in brackets or something. So individual important, individual separate. And even in GAP Code of Conduct, for example, the standards will tell you, that you should do this, you should not do this, or you should do this. The question will not be direct. The question will not ask you about the standard. What the question is going to tell you is, they'll give you a situation that this guy was a risk manager, he was working in so-and-so bank, he had a client, the client asked him to do this, he did that, then this happened, then that happened. Now tell me whether a violation has happened or not. And if a violation has happened, which standard has been violated. So the question is going to be coming from that perspective. So as I'm telling you that please do not take theory for granted, because the theoretical portion becomes all the more challenging. Because in numerical you can solve, get an answer. In a theoretical question, your concepts need to be very clear. So the whole thing, it's not difficult. The only thing is whether your understanding is thorough or not. Your understanding is what you need to focus on. The rest is not going to be a problem. Moving on to the next book. So when I'm looking at quants basically, so there is a reading time value of money which is not provided in your material, but time value of money is the first thing you'll have to start with. So the book, when you're looking at the institute material and all, they're all starting with probability as a topic. But time value of money is a topic that you have to do, because if you do not understand time value of money, you cannot do fixed income related chapters, you cannot do derivative related areas, because all throughout the curriculum, even portfolio, all throughout the curriculum you have to understand calculations with respect to money will be there. And if money related calculations are there, you have to be comfortable with respect to time value of money, money related calculations. So although time value is not a part of the curriculum, and students keep on asking me that why do I have to do TVN, like time value of money has a portion on amortization. So when, say for example, if I'm taking a 1 lakh rupees loan and I'm paying an EMI, let's say, so the EMI I'm paying is, let's say for example, I'm paying an EMI of 15,000 rupees for the next 10 years. So I've taken a loan of 1 lakh rupees, but I'm paying an EMI. I know it's not a monthly installment, it's an annual installment. I have to make a 15,000 payment for the next 10 years. What is the total amount of money you're paying? 1,50,000? So 1 lakh is a repayment of principal portion and 50,000 is a repayment of interest. There is a part of principal I'm paying every year. So my principal balance from 1 lakh rupees keeps on declining and becomes zero over a 10-year time horizon. What is the interest rate? What portion of interest I've paid and what portion of principal have I paid? Now when I do bonds and mortgage-backed securities and all, mortgage-backed security, what do you understand? Mortgages, home loans you're taking. If you don't know the calculation on loan and loan amortization, how do I teach you mortgage-backed securities? Are you understanding my problem? So time value of money is the first reading that you have to do in quants. It was earlier a part of curriculum. They removed it from the curriculum in 2019, but it does not make sense because you anyways have to study it. Otherwise, you cannot do any other chapter. So time value of money, although not a part of your curriculum, I will be teaching and you will have to study. Tell me, everybody with me? The second, as I told you, we start with probability. Now earlier until 2019, if you would see, the syllabus was the curriculum of the first book is more or less similar, but with much better arrangement done with respect to portfolio and all. The second book has been upgraded almost 20-30%. So in the first book, we do not see so much of changes as such, but the rearrangement and the material has been made much better. And as I told you, 2020 onwards, the GAP has started providing their own material. We have the access to institute material. But when you're looking at the quants subject over here, there has been a 20%, 30% upgrade almost in the curriculum. 20%, not 30%, 20% upgrade has happened in this particular curriculum. So when you're looking at probability, as I told you, time value of money is all the money related calculations. Time value, compound interest, simple interest. Simple interest, of course, we'll not be looking at, but compound interest. So if 100 rupees is invested today, what it becomes after 10 years. So all the money related calculations. Now probability is because, say for example, if after 5 years I'm expecting, or let's say next year, so I think that there is a 30% probability that the market is going to be good next year because of the consumption that we can drive probably in our country. There is a 50% probability that the markets are going to be flat because the global economy is bad, uncertainty is there, but the Indian consumption economy is going to counter that effect. And there's a 20% probability that the market is going to be doing really poorly because I don't see the credit structure very well right now, and I'm not very optimistic about what is happening with respect to the global economy. So then what will be my expected return for the next year? So there is a 30% probability my return can be 15%. There is a 50% probability the return will be flat at, let's say, 10%. And there's a 20% probability that my return is going to be 2%. So what is my average expected return? So you need probability in order to do all those kind of calculations. And also when I'm looking at probability, how do I calculate probability? The calculation of probability is going to be based on past data. So out of 100, say for example, we've done those kind of questions in class 11, 12, where out of 40 students, 20 students have a height of this much, 25 students have a height above this. So 25 out of 40 students, if they have a height above this, so I just convert it into percentage and I say 25 into 2.5, 62.5% students are going to be taller than this level. What I'm trying to do is, I'm trying to extrapolate the past to the future. That is what I'm trying to do when I'm talking about probability, when I'm studying the old data, and on that basis I'm trying to give a probability for the future year. Then a lot of jumbling up and all has been done. So we have probability, then there is a reading called random variables. Just give me 1 second. And then we have some certain distributions. They're calling it common univariate. So random variables we are going to be discussing in this reading. We are discussing 4 moments like average and mean and median and all of those things. Just a second, I'll just tell you they've done a little bit of rearrangement here. Expected value, mean, median, moments of skewness, kurtosis. We'll start off with a basic discussion on quartiles, median and all of those things. Yeah, when you come to the common random variables, so random variables, again we are trying to study data. Now the statistic starts off. Immediately after probability, your statistic portion starts off. In common univariate variables, you'll be studying Bernoulli distribution, binomial distribution, Poisson distribution, beta, exponential, etc. So a lot of distributions we are going to study. Now even when you're looking at a binomial distribution, for example, so let me explain how the application works. Binomial distribution, say suppose there is a flight which you're booking, there's a flight with 100 seats. Now an airline, generally what they do is, they'll sell 102 tickets. Why? Because on an average, there'll be 2 people who'll be either missing a flight, or let's say arriving at the airport late and missing their flight anyways, or cancelling the flight last moment. So by selling 102 tickets for only 100 seats, I'm ultimately going to be generating revenue of 2 seats free of cost. Those kind of calculations, how many seats to sell, etc., could be based on binomial distribution. I'll give you another example. Let's say, for example, we are talking about bonds defaulting. Let's say there is a bond index. I know, don't worry about, that I don't know these terms, I'm not understanding these terms, because I've not taught you these chapters. I'm just trying to give you a brief overview. There might be a possibility where you have a problem with bond. Bond is like a FD, the loans that the companies are taking. So let's say there is a group of bonds, there is a group of 100 bonds. I want to find out what is the probability that at least 2 companies or 2 bonds out of these 100 is going to default. Binomial distribution can work. Binomial distribution, 100 C2, 2 out of 100 bonds defaulting, what is the probability? So if I know the probability of 1 bond defaulting, what is the probability of 2 bonds defaulting? And 2, there could be 100 C2 ways of selecting 2 bonds out of 100 bonds. It can be bond 1, bond 2, bond 1, bond 5 defaults, bond 3 and bond 7 defaults. There can be 100 C2 combinations. So now if you're getting scared I have to do combination and permutation and all, don't worry, because on your financial calculator you can type 100 C2 equals 2 and you'll get the answer. So it's not that you have to do difficult questions on permutation combination or something. It's just that we are going to be applying the concept of permutation combination here. Tell me, are you understanding this? So we'll have something called common random variables which we'll discuss. Then we have discrete random variables where we'll be talking about different kinds of distributions and all. Say for example, when you're throwing a dice, so it's going to be giving you an answer of 1, 2, 3, 4, 5 or 6. There are 6 possible outcomes. You toss a coin. There are 2 possible outcomes. But with respect to, let's say, rainfall in a region, it can be anything between 0 centimeter to, let's say, 100 centimeter. It can be 99.51 centimeter. It can be 99.52 centimeter. So you can't say that it has to be either 1 or 2 or 3. You cannot count the outcomes. So what is the distribution of data? Distribution of the returns of a stock. Say for example, the tax rate. It is either you'll be charged at 25% or 30%, depending on which company you are. So you have 2 or 3 options. But if I'm looking at the returns of a stock, the return can be absolutely anything from minus anything to plus anything. You cannot exactly say that the return is going to be limited only to this particular value. Right? So the return can range from any value to any value. You cannot say the return will either be 10 or 11. It can be 10.1592, 10.1593, can be absolutely anything. So continuous distributions. So we need to understand multivariate random variables and their distributions and all. Then we are going to get into the reading on sample moments. So we talk about standard deviation, variance and all. So say for example, I can say that the stock on an average is giving me 8% return. So that is the average return of the stock. Now what I want to talk about is I want to understand the variance of the stock. I'll give you 2 examples. So there is a stock which has an average of 8% and sometimes it's 7, 8, 8.5, 9, 9.5, 7, 6.5. It ranges around this area. And there's another stock. At times it is giving you a 2% return, sometimes 20% return, sometimes 15% return, but the average is 8. But the movement of the stock is in this way. Which stock is more riskier? First one or the second one? Second one. So that is going to be measured by variance and standard deviation. And now it's not that, the way those who studied a little bit of statistics in school, it is not that we have to draw columns of x and x bar and x minus x bar whole square and do it tediously. Because you can feed all your data in the financial calculator and it will give you all the outcome immediately. What we need to do over here is in terms of understanding. The objective is understanding over here. It is not going to be making tables and doing calculations, and if one plus or minus I make a mistake, I'm going to be messing up, because we are going to be using financial calculator over here. So we have to understand the calculation of mean, median, mode, correlation and covariance. Let me explain what is correlation covariance. So as it's the easiest example I take. So there are 2 stocks that we are going to choose, stock A and stock B. So when A increases, B increases. When A goes down, B goes down. So A and B move in this manner. There are 2 another stocks, there are 2 more stocks, X and Y. If X increases, Y goes down. If X goes down, Y goes up. So both are going to be moving in opposite direction. When the 2 stocks are moving in opposite direction, the total portfolio, the total of X and Y increases in this manner because they're balancing out each other. So now you tell me which portfolio, A and B or X and Y, which portfolio is more risky? A and B, the first portfolio. The first portfolio had a positive covariance or correlation. Both the stocks were moving in the same direction. But in the second case, the stocks were moving in the opposite direction and therefore balancing out and cancelling out each other's effect. So the second portfolio was relatively going to be having a lower amount of risk. So when we're doing calculation of risk in portfolio, the covariance or the correlation becomes important. So when you study portfolio, you need to make sure that the covariance correlation part is taken care of. Tell me, are you understanding this? So are you understanding how the application of statistics is important? You will not get a difficult question on calculation of covariance correlation. Calculator can give you that as well. The point is going to be able to apply and understand the covariance and correlation part. And also again, I'm repeating this because students get very paranoid with respect to mathematics, but you have to understand it's statistics which you've barely studied in school, because in school I remember there were only 2 chapters we used to have in ISC board in class 11 and 12. There used to be 1 chapter on probability, and that too with those difficult questions on dictionary questions on permutation, combination, all if you guys remember. And tables, there are 5 people sitting, 1 guy walks out, 1 guy enters a party, and all those kind of little difficult questions used to be there. Although interesting, and I used to thoroughly enjoy those questions, but that is not what we are learning over here. So permutation combination question will not turn up in a difficult manner. Just that you need to be able to use an NC2 on the calculator, a 10C2 or a 100C2. So the application is here. Right? So don't get worked up. You might have to put in a little extra effort, and you should not have a problem with that. Of course, you'll have to learn something. When you're doing a hypothesis testing. So hypothesis testing again. So basically when you're doing a research, see, you cannot exactly guarantee that a stock price is going to be going up or the stock is going to go down, or the interest rate is going to go up or interest rate is going to go down. You cannot give a guarantee. What you do is, say as a researcher, you've gone through a lot of data, you've done a lot of analysis, and based on that you have a thesis, you have a statement that according to me interest rate is going to go down or interest rate has gone down. Now you need to check the validity of the statement. So hypothesis testing is, if you've made a statement, how do I check the statement? I study the past data, I analyze the past data, and based on that I do some kind of testing. So it's a little difficult chapter, but once we do, you'll understand. It's difficult to explain in a short manner right here, right? But hypothesis testing is, if a statement is given, you study the past data, and based on that you have to check the validity of the statement, whether the statement is correct or the statement is incorrect. Right? Hypothesis, I'll not get into more details because it's a little complicated chapter. Once you do the chapter, you'll understand, not a problem. Then we get into the regression portion. So there are 2 readings on, there are 2 or actually 3 readings on regression. So you can bracket those 3 together actually. Linear regression is there, then multiple regression is there, regression with multiple explanatory variables, and regression diagnostic. So those 3 are a part of your regression together. So basically the reason of making you mark it in this way is that these are chunks of chapter. So suppose when I'm studying, and even when I give you the order of studying, these 3 chapters you'll do together. So you can't do 20 all the things parallelly. So you complete these 3 chapters, then you can shift to another subject if you want. That also has to be a logical sequence, which I'll tell you, so that we can alternate theory and practical subjects. We can push more of those chapters which are difficult to retain towards the end of the curriculum. And you also have to understand the dependency, like till hypothesis you'll have to do quants in the first half, because a lot of other subjects are going to be needing basic concepts from here. So like from probability to hypothesis testing, we actually put it as one chunk. So from the probability chapter, from the first chapter of quants till the hypothesis testing we've done, that is like one chunk. So you bracket that together, so that whole thing is one. So the first 6 chapters or so, from the first chapter probability till hypothesis, is your basic statistics. So probability and stats. So that is one chunk which you need to do together. Then you do the regression 3 readings. The regression is basically very simple. So say suppose if I want to form an equation, y is equal to b0 plus b1x. In school you might have studied this equation as y equals to mx plus c. The idea is we need to be able to form relationships. Now if I want to say that a particular stock is going to do well, how do I do that? So, or say for example I want to make a forecast about Maruti Suzuki. So how do I manage, or how do I analyze Maruti Suzuki, whether the Maruti stock return is going to be higher or lower? Maruti's return depends on multiple factors. One of them could be, let's say, GDP of the country. So if people's income is high, if the economy is doing well, there will be more money in the market, and therefore people will be buying more cars over here. So therefore my return should be higher. There could be another variable. I can have multiple variables over here. Let's say b2x. Say for example, and the next variable x2, sorry, this will be x1, this will be x2. So say for example, I'm taking another variable, and that is, let's say, interest rate. If the interest rate goes down, therefore the return of Maruti goes up. Why? Because if interest rate goes down, the ability to take and afford a car loan is going to be cheaper. So therefore, the affordability goes up, and therefore more sales will happen. Also in valuation of securities and all, we'll get to that part later when we do time value of money. So the B2 should be negative, because if interest rate goes down, the return should go up. So we can have different variables. We can have b1 x1, b2 x2, b3 x3. This becomes with multiple variables, regression with multiple variables. So how do we do this? That is going to be part of regression. So forming the equation so that, because I want to make a forecast about one variable based on certain factors. Whenever you want to analyze something, you have to first of all determine the factors it depends on, right? If you want to understand how will my exam go, there will be multiple factors. How much did you study? Were you concentrating? What my practice you did? So these variables will determine whether you clear or not. So to forecast any outcome, the inputs have to be understood. What inputs need to be, what are the input variables that you need to analyze? Then we come to times. Then there are two readings that you can bracket together, that is stationary time series and non-stationary time series. So this is going to take regression to another level. I'll discuss this in details when we do the chapter. It is going to be on a difficult side. You can write difficult over there if you want. This is going to be a little difficult in terms of chapter. And regression diagnostic is analysis of this equation. We'll get into more of this equation because the equations cannot be so it's not that easy to say that this will exactly happen, or the equation that you frame is a guaranteed correct equation. It does not happen that way. Like, you cannot forecast the future accurately, right? So what are the issues in your creation of equation? For example, if I'm trying to make a forecast about something and you never imagined a demonetization is going to happen before 2016. So before 2016, the equation you made is fine, but if demonetization happens, that equation is not going to be working anymore. Or say, suppose the equation that you have made for the valuation of a stock like a PVR or an INOX, that equation is not working, or the equation has to change after the launch of Jio in the country. Because Netflix and Amazon comes up, the data has become extremely cheap and people are getting access to all these platforms online. Because of Jio and Netflix, the valuation of PVR should be affected. Because of Swiggy coming in the market, Domino's valuation should be affected. The company is Jubilant Foodworks. Because earlier Domino's was the one who was able to give that home delivery service. Now the variety of all the restaurants in your vicinity have the same ability to serve you food at home because of Swiggy. So therefore Domino's company, that is Jubilant Foodworks, does not advantage that USP of its unique selling point anymore. So therefore the equations might change. So how do you analyze that? Or the kind of data you collected, what could be the issues in the data, what could be the accuracy level. So understand the accuracy level of this equation. And if you guys understand, machine learning and all is going to take this equation to another level. It is a linear equation. See, the power of x1 and x2 is 1. You can have equations with squares and cubes. Machine learning, for example, what video you would like to watch based on your behavioral analysis. They will give you recommendations on Facebook also, videos you may like to watch. Or YouTube, they give you recommendations. That's based on your behavior. So they study the relationship between, the kind of stuff I watch and the kind of stuff she watches. So say, for example, if I have been watching a Castle and a Big Bang Theory and a Fresh Off the Boat, and she's also watching the same 3 sitcoms, and she's watched the 4th one. Since our behavior pattern is similar, the 4th one that she watched is going to be recommended to me. And YouTube wants us to watch more number of videos. Why? Because then they will be earning more advertisement revenue. The more the views, the more the revenue for them. We are the raw material. Our time, our social life, our mental health is the raw material for these companies on which they are consuming. Now it depends on you how mentally strong you are going to be in order to prevent them from earning out of your life and sucking out of your time and your productivity. They're absolutely sucking out everything from you in order to make money, including Netflix and Amazon Prime and all. Amazon, by recommending products and by making shopping easier, it has made us more consumeristic. Are you understanding? You would not have been buying such useless products or the number of things that you buy just because there's an offer or something or the other. Ultimately, they are preying on you. They're literally eating out of you, eating you up. So we have to start thinking about these things as well. You're understanding the idea? So it's very important today to be very, very mentally strong in terms of how the social media is impacting you. Anyways, moving forward, so time series and non-stationary time series is going to be a little level up as compared to regression. For example, like if I talk about a time series, like a question, let's say suppose the temperature is increasing day by day. So therefore the ice cream sales should be going up. So today the temperature rose, I was not able to eat an ice cream. Tomorrow the temperature rose again, I'll probably have an ice cream tomorrow. The third day the temperature rises again, I'm definitely going to go and have an ice cream. So ice cream sales on third day could depend on the increment or the changes in temperature. It could also increase whether it is, let's say for example, a holiday or not. On a holiday the sales could be relatively higher. It could also depend on the sales that has happened on a previous day. So if too much ice cream has been sold on Sunday, then even though the temperature increases on Monday, there should not be more sales in terms of ice creams on Monday. So even when you're looking at stock market trading and all, after the New Year and the Christmas vacation, there are changes in market. So how do we see that? Holiday variations. So these kind of things we need to notice. So that is what we're looking at with time series and non-stationary time series. Although going to be a little complicated as I told you. Then we move to a reading on, so you can bracket that. Stationary time series, non-stationary time series is together. So we've got one chunk of quants, we've got one chunk of basic stats and probability. Then we've got a chunk of time series, regression. Then we've got time series, 2 chapters. Then we have 2 unrelated kind of readings. One is measuring volatility and correlation. So that is with respect to forecasting volatility and correlation. Beside that you can write related to book 4. So when we do book 4, this chapter becomes related to the book 4 portion. So when I come to book 4, I'll discuss. So related to first 3 chapters of book 4, if you want, you can write that against volatility and correlation. So when we're doing volatility and correlation, it will be linked to the book 4 couple of chapters in book 4. Again, understand volatility is very important. Why? From a FRM point of view, from a risk management point of view. What does volatility mean? The movement. If 2 stocks are moving in this way, or if the portfolio is moving in this way, the volatility is low. If the portfolio or the stocks are moving in this way, the volatility is high. Volatility is risk. So when you're looking at risk management, of course, volatility becomes important. And forecasting volatility, how the markets are going to be, how volatile is it going to be. At the time of elections, of course, the volatility goes up. At the time of elections, there is a high perception of volatility because depending on the result, the markets may be very good, may be very bad. You don't know who's going to come to power. Right? So around major events, the volatility in the markets increase. And when the volatility increases, you might be getting a huge profit, but you might be getting a huge loss as well. So how do you prevent yourself or hedge yourself from that magnitude of loss? Risk management, which is what we are doing over here. Tell me, are you understanding this? And the last reading is with respect to simulation and all. So it's a relatively theoretical chapter. The problem with this reading is going to be that it is more of something that we do on a software. So studying something on paper, theoretically, logically, understanding wise, but the application happens on a software, simulation. So you play simulation games and all. Say for example, I want to generate a random number. We will study something of that sort over here. So how does a random number generator work? So say suppose I'll take a random figure. Just give me a random number, 30. Give me a 4-digit random number, 3858. So now what I'm going to do is 3858 square. I will get a big number. I'll take the 4 digits in between. Then I'll do the square of that. I'll get a big number. I'll take the 4 digit in between. Obviously the 4 digits in between is going to be relatively random. And you keep on doing this process till the time you get 3858 again. Because then a loop will again start off. If you get 3858, then the same numbers will be repeated. Do you see how I'm able to generate a random number? So these kind of things we'll probably study when we're doing simulation and bootstrapping. So simulation will be when you want to do multiple different outcomes. You play those games, right? Farm Frenzy and God knows what all rubbish. We played better games, Roller Coaster Tycoon and Zoo Tycoon and all those things earlier. I don't know if in school days you played those games. What used to happen in those games is like, say for example, you are responsible to build a park from scratch. So which ride you'll place where and what will be the charges of the tickets and then how many people are coming up. That is like, so if I have taken these series of decisions, this is the income I generated from the adventure park. Me as a user. So what example are you giving? Ideal supermarket. I don't know. Okay. So say for example, you played the same game. You have followed a certain series of steps. You landed up with another revenue. He's played the same game. He has started with a series of steps and he landed with a certain revenue. These are all simulations. So different combinations and series of steps if I follow, what are the different outcomes? Based on that I can study what will be the average outcome and analyze that. Tell me, are you understanding this much? So this is what we are studying in quants. So the first half is of quants and the regression part is fairly simple. The only difficult part will be the 2 chapters on time series. Otherwise you're going to be finding quants pretty okay. And it's more about statistics than anything else. Then we move to the next one, that is your financial markets and products. So financial markets and products, when you see the first three readings, is the bank, insurance company and fund. So earlier, we used to have like 3 chapters on banks. Now they've consolidated that and put it all together into one reading on banks. So we have a reading on banks, and it's important to understand the business model and the working of bank. What is a bank? How does it work? And the basics around it. It's not going to be that basic. It's not like a school 11, 12 commerce textbook kind of banking, but we'll be studying in more detail and in much better manner. What is bank all about? The risks and all the bank faces, and how the entire structuring and functioning of different kinds of banks. There are deposit banks, there are investment banks. So there is a difference. So there is a bank where you deposit money and they loan out money. That's a simple commercial bank. There could be investment banks also, where the companies approach these banks in order to do fundraising and all. So that will be a part of your investment banks and all. So we study the banking industry. We study how the insurance company works. Insurance company also will be studying the life insurance and property and casualty insurance. There's a huge difference when you're looking at that, because when you're looking at a life insurance company, we people start paying insurance premiums when we are young. When we die, the company has to make the payment. So the company is going to get premium for a longer duration, and the payment has to be done at the end. So the company has got our money for a long time frame, and deliberately will not try to die generally unless you're watching rubbish like 13 Reasons Why, or playing that Blue Whale channel and challenge and all that rubbish. So, and the second alternative, a property casualty insurance, a fire insurance. I take a fire insurance today, I'm insured for the next year. I'll again have to pay the premium if I want the insurance to continue for the next year. Having a fire this year and having a fire next year is not related. There is no way, it's very difficult to predict the number of fires. But in terms of life insurance, there's a relatively better predictability on an average at what age people die, in what city, what kind of lifestyle do you lead, and based on that, an average age at which you're going to drop dead is relatively forecastable. Tell me, are you following this? So how is it? So do you understand there's so much of difference between a life insurance company and a property and casualty insurance company? Right, so how do you differ between the three? So the first 3 readings, and then there's the fund management, which is mutual funds and hedge funds. I'll not spend much time in discussing hedge funds right now. Funds, so when people pool in their money, we all deposit small amounts of money, and that fund is managed as a whole. That is your mutual funds and hedge funds and all. Hedge funds I'll not discuss right now, as I told you. So when you're looking at the first 3 readings, bank, insurance and funds, so that is relatively theory, easy and good chapters. So these 3 we do together generally. So because these are relatively more basic, so you need to understand what a banking organization is, what an insurance company is. So we do this a little at the earlier, in the earlier part of our curriculum. Just give me 1 second, there is one more. Alright, I'm going to jumble up in terms of the serial order right now. There are 2 chapters towards the end, if you would see, somewhere in the middle actually. You see interest rate, corporate bond and mortgage-backed security. 1 second, just give me 1 minute. Just give me a second. This you've understood, these 3 chapters are like one bracket, we do it together. Then you have introduction to derivatives. I'll have to write this actually. Now here starts a little bit of confusion. So when you're looking at book 3 and book 4, basically, there will be a little problem. I'll explain, you don't have to write down right away. So basically what happens is there are certain topics where 3 chapters of a topic is covered over here and 3 chapters is covered over here. Now what happens over here is, you've seen banking, insurance and funds, that is fine. Now there is something called fixed income. So fixed income securities and all the interest related calculations, bonds, fixed income securities, interest rate, they're all a related group of chapters. So you have a reading on interest rate, on corporate bonds and mortgage-backed securities. Mortgage-backed securities are also bonds, but that is based on real estate. So say for example, the bank is giving home loans. The bonds which are based on those home loans are known as mortgage-backed securities. Again, as I told you, it will take me 1 hour to introduce this topic. I cannot explain in a very, very short manner, but they're all fixed income related instruments. So when you put money in the bank gives you an FD. When you buy the bond of the company pays you interest. I'm buying a 12% interest bond. So the company I've given, let's say I've bought a bond of $10,000. I've bought a bond of $1,000 for 10 years at the rate of 12%. So I'll pay 1,000 to the company today. The company pays me 12% interest for the next 10 years. And after 10 years, the company pays me back my $1,000. So that is your bond. So when you're looking at fixed income related securities and the bonds and all, that is all a part of your fixed income section. So there are fixed income chapters in book 3 and there are fixed income chapters in book 4 as well. 1 second. Valuation and risk model. So you have fixed income related chapters in book 4 as well. Right. So that is why the order of study is going to be quite jumbled up, as in we will not go in serial order. So let me explain the entire curriculum. So there is something called derivatives. Now what do you understand by derivatives? As I told you, we try to insure ourselves with life insurance, health insurance, accident insurance, fire insurance, etc. Our businesses with fire insurance and all. But there are a lot of other risks. Risks that interest rate might increase or decrease. Dollar rupee rate might increase or decrease. The commodity prices might go up or down. Oil prices, we have seen the oil prices starting from $140 per barrel around 2008. It touched $20 per barrel after that, and then again it went up to $60-70 per barrel. Whatever happens with respect to Middle East, and the oil prices keep on fluctuating, and we people suffer a lot because 80-85% of the oil consumption that we have in our country is imported. So the moment dollar fluctuates or oil prices fluctuate, it increases, it affects our exchange rate as well. Because if oil prices goes up, we'll have to import, we'll have to pay more dollars. Our currency also gets affected. So when you're looking at the risk management part, derivatives becomes the most important part of risk management, because it is through derivatives that you will do risk management. How will you manage the risk of, you taking care of your family if something happens to you? Through life insurance, right? So how do you manage risks and variety of risks in business? Or any kind of exposure. Say for example, I'm expecting interest rate is going to go up and I want to bet on it, or I want to make money out of it. So all the risk management related management of the risk is going to be through derivatives. So derivatives becomes the most important topic when you're looking at FRM and risk management in general. That is what we are going to be studying in both the books portions. And there are 4 kinds of derivatives: forwards, futures, options and swaps. Again, as I'm telling you, I'm not going to be able to explain the individual derivatives right now, because as I told you, it's going to take me a good amount of time to just do derivatives and the basics and understanding. But there are 4 readings on futures. Futures, there is a chapter, futures hedging, where I'll tell you the chapter name exactly. So we have future markets is there, we have using futures for hedging, we have pricing futures and forwards, we have commodity futures and forwards. So we have 4 readings around futures and forwards. This 4 you can bracket together and write F and F, futures and forwards. There are 4 reading on futures and forwards. So when we do the readings, we'll be doing all the 4 together. We'll be doing all the 4 together. Futures and forwards, we'll be doing it together and not in the same order. This I will take care of, you don't have to worry. I'll tell you the exact order. I'll tell you the order of study and I'll tell you the exact order, but I just want you to again mark your index so you know that this is one group. So there are 4 kinds of derivatives: forwards, futures, options and swaps. When you're looking at options, there are 4 chapters of options in book 3. Book 3 options has got options, properties of options, trading strategies using options and exotic options. In book 4, that is your valuation and risk model book, you have 3 more chapters on options. Binomial tree, Black-Scholes-Merton model, and option Greeks. So when we do options, we'll start with options over here, we'll end with options over here. We'll do all the 7 chapters together. Even when you're revising, you'll revise all the 7 chapters of options together. That is the reason why I'm making you understand that these are one chunks of your curriculum. This 7 chapter is under the group options. The first 4 chapters are in the book 3, financial markets and products. The 3 chapters are in book 4, valuation and risk models. Tell me, are you guys understanding this? Again, I'll not get into the details of options because I'll not be able to explain in a very short manner what is options all about. But one of the most interesting derivatives, out of 4 derivatives, forwards, futures, options, swaps, options is the best one to study. It's very interesting. So even with respect to stock traders and all, they use a lot of options in order to take exposure. So options extremely interesting. Depending, even for trading and stock markets and all of those things, your options is going to be very, very useful. The next derivatives, that is swaps. Now the problem with swaps is going to be that you need to have a decent understanding of fixed income instruments to be able to understand and do swaps related calculation. So what we will have to do, again as I'm telling you with the order of study, we'll have to first do the fixed income portion, which will be interest rate, corporate bond, mortgage backed, and there is a fixed income portion from book 4. We'll do the fixed income portion, then we'll again be able to get back to swaps, interest rate, futures, and this portion. Are you understanding this? So we'll have to do the options part. We'll understand forward, futures, option, swaps. We'll understand the options part. We'll do the fixed income portion. Then we'll again get to swaps. Or maybe we'll start with fixed income, then come to derivatives. That I'll give it to you. But you're understanding the chunk of it. Swaps and interest rate futures, we'll put it together because interest rate related derivatives. You can bracket these together. That's fixed income part of book 3. Forex, you're going to be separately studying. So foreign exchange risk, so all the risk with respect to currency and foreign exchange. There's been major upgrades in the chapter and they've made it really interesting. They've added really relevant portions which is needed for the industry right now. And derivatives, when they are done on a larger scale, OTC, there is something. So after you study derivatives, you can study these 2 chapters, bracket these 2. Exchange traded derivatives and over-the-counter derivatives and central clearing. You can bracket that together, and if you want you can write CCP. This has to be done after derivatives. You can just write CCP. Once we study the 2 chapters, you'll have an understanding. And there's a chapter which is unnecessarily given, introduction to derivatives. So what is forwards, futures and swaps and options is what is covered over here. But once you do futures in detail, options in detail and swaps in detail, this chapter is going to be more of a formality of skimming through it. You'll just have to roughly browse through it. We can't do this chapter first because if I have to introduce, I'll take 2-3 hours to introduce forward future, a few hours for options, a couple of hours for swaps. So I'd rather cover all the 4 topics in detail and then you can just go through it as a formality. We'll do it in class so you don't have to worry about it, but that is what it is. So this completes your book 3 portion. Tell me, is everybody comfortable? We move to the last book. Alright, so if you're looking at the index, there are first 3 readings, measures of financial risk, calculating applying value at risk, and measuring and monitoring volatility. You can bracket the 3. The first 3 chapters basically forms a part of VAR. Very, very important section of FRM, value at risk. Value at risk is something that is used very frequently by the banking and all the financial institution organization. It is more about measuring risk. So of course, when you're looking at something like a financial risk management, measuring risk becomes quite important. So the first 3 readings are going to be with respect to your volatility. So measuring volatility, forecasting volatility, the volatility related risk and all, value at risk. And also what happens over here is we need to understand something called the tail losses. Now, if I were to explain this, so this is a part of your normal distribution, let's say. So those who understand normal distribution or any probability distribution, so basically what I'm saying is, let's say the probability is 5%. If I can find out this value, I know some of, just try to understand very superficially, we'll discuss these things. So basically I can say there is a 5% probability that my losses will be more than this level. So what I've done is, say for example, I've collected losses for the last 1000 days. I have collected my profit or loss for the last 1000 days. What I do is I arrange all those profits and losses from the worst to best. So the worst loss was, let's say, minus 28% loss. What I'm going to do is the 50th worst loss was equal to minus 2.5%, let's say. So the worst loss to the best profit. So this was giving me 46% return. So the best profit I've made is 46% return. The worst I've made is minus 28% return. There are 1000 losses like this. I have arranged in ascending order. The 50th point, 2.5% basically tells you approximately 50 values, 50 losses are less than 2.5%. 950 values are above minus 2.5%. 95% of my returns are above minus 2.5%. 5% losses are even more than 2.5%. So what I'm stating over here is there is a 5% probability that my loss is more than 2.5%. There is a 5% probability that my loss is more than 2.5%. It becomes important for you to calculate these kind of variable metrics for banking organizations. Why? Because we have to minimize the probability that a bank can ever default, that a bank can ever go bankrupt. Because if the banks also cannot guarantee our payment, then where do we deposit our money? Where do we save our money? Where do we put our money? Which is going to create a major problem in the economy, because if we can't put our money in the banks, the economy will not have funds, liquidity. How will there be growth in the economy? So this becomes quite important. So the entire value at risk, this is value at risk. This 2.5% will be value at risk. So studying things around it, the first 3 readings is going to be this. And if you remember, I had a volatility chapter in quants. So this is going to be after that. So when we do the volatility chapter of quants, we do these 3 chapters. So we do quants ka, that volatility chapter of quants, we are going to be doing it later. We do that and then we do these 3 chapters. I'll give you the order of study, don't worry about it, but this is how we are going about it. Tell me, comfortable? In this particular book, we are going to be having a few theory chapters also. The next reading is internal, external rating agencies and ratings. So when you're looking at bonds and all, even our countries do get ratings. Do you know that? So India is also provided ratings. So there are bodies like S&P, Standards and Poor and Moody's and Fitch and all these. So they provide ratings to countries also. So if India's rating goes up, that indicates that we are in a very good position. We are in a relatively safer, growing position, and investors can safely invest in our country. So that is the reason why we want to go up, go down, go up in terms of corruption index, in terms of ease of doing business, in terms of innovation, in terms of human skills and power. A country wants to get into the best possible rank so that there will be more investment coming in. Right? So that is what we are looking at in terms of internal and external credit ratings. Not just from the country's point of view, but more from the company's point of view. So if, say for example, Tata's rating is AAA, so I would not think about investing in the bonds of Tata. But if I'm looking at SpiceJet's rating is CCC or let's say BB, that means that the company is not so sound, it may not be that safe an investment. So how does a rating agency works? So ratings also tell me if the company has got a poor rating, that means it has a higher probability of default or a lower probability of default. Higher probability of default. If the company's rating is poor, that means there is a higher chance of default. So we need to study this part. The next reading is your country risk, which is again external internal rating is more on the easy theory part. Country risk is also going to be more on the easy theory part. So in country risk, as I told you, your GDP, your political risk, amount of debt you've taken. So all these factors will determine how much of risk it is to invest in a country. Now today when you're investing in a US, you'll not be very scared of investments. Because you know that the rupee dollar exchange rates are also relatively stable. The government is stable in US. Things are good and there is more transparency. The possibility of fraud is lower. But when you're investing in a Britain today or a UK today, like today it's fine, but earlier if you would have been investing, you would have been scared of whether Brexit will happen or not happen. If Brexit happens, how will my investment get impacted? If Brexit does not happen, then how will my investment get impacted? Are you understanding this? Everyone following? So country risk. So country risk is also something we have to study when you're making cross-border investments and all. For example, I have got a little exposure. I just put 10,000 rupees in this Motilal Oswal. There is a Nasdaq fund which invests in the US Nasdaq that has got Google, Apple, Facebook and all of those stocks, right? So that is your country risk. Again, easy theory, good chapter. Then you have measuring credit risk, which has been absolutely newly introduced from 2020, and so a little bit of calculations, credit risk. So generally more from a banking perspective. So this chapter is going to be more from the bank's point of view, credit risk. So if I have given money to someone, whether he will pay me back or whether he is going to be defaulting on the amount. So that is what we'll study broadly in credit risk. Operational risk, again, we are going to be doing it from the banking point of view. So operational risk when a company is being run. Say for example, when you're looking at a bank. So a bank's website gets hacked or ATM credit card details are out. That is why they keep on upgrading the chips and all, and they have an OTP also. So how do the banks manage their operational risk? There is fraud risk, cyber risk. What is if an employee is stealing away from the bank? So what if they are accessing, what do you call it? If the banks are, if these employees are accessing incorrectly, they're accessing data from the bank's records. So you have those details also, when, who opened the account, who accessed the data. So these things are there today. You have those key card access and all those things, biometrics and everything today. So we have to prevent operational risk as much as possible. I'm giving a very broad idea. We're going to be studying operational in more detail, and operational risk is going to be a full subject in part 2. Credit risk is going to be a full subject in part 2. So we're just going to be having a relative introduction when we're doing these chapters right now. The next one comes to is stress testing. So earlier we had like 2-3 small readings on stress testing. Now we've got it all together into one stress testing chapter. When you're looking at stress testing, basically it is very important today. A lot of banks are conducting stress tests and all. Now just imagine in 2008 the condition, the severity was very extreme. Say suppose if the markets, if the companies did not have so much of a problem, if the banks did not have so much of a problem of liquidity, as in they had funds, the market would not have fallen to this extent, and things would not have gone bad to this extent. Things would not have, Lehman Brothers dubta nahi. Lehman Brothers would not have gone bankrupt. It was an extreme event that happened, right? So in stressful situations, will you be able to survive? We've seen Jet Airways failing, we've seen Kingfisher failing. So what do you expect? Air India is just there on the mercy of, at the mercy of the government. So in stressful situations, will you be able to survive? When the oil prices go to $140 per barrel, will you be able to survive? Say for example, the Middle East countries. I'm moving a little off topic, but when you're looking at the Middle Eastern countries, their oil prices, when they went down below $30 per barrel, almost touching 20. These people eat food, they get everything. By selling oil, they are going to be able to purchase everything from abroad. How will these Middle Eastern countries survive? That is why they are now diversifying. They are trying to attract more money in from being a finance hub and with respect to tourism and everything. Because they don't want to be dependent totally on oil, because we are also moving towards cleaner source of energy, and oil is a non-renewable source of energy. So stress testing anyway. So stress testing is basically you push variables to an extreme level. Let's say for example, if the oil price is $140 per barrel, will Asian Paints be able to manage? Asian Paints is a lubricant company which has oil as a major raw material. So will it be able to survive? So in extreme situations, are you going to be able to manage or not? Then the next few readings, so there are 4 readings basically. Pricing conventions, if you see, discounting, pricing conventions, arbitrage, interest rate, bond yield, and applying duration. And then modeling non-parallel term. You can bracket all the 5 chapters together, fixed income. That entire section is about fixed income. So it's pricing conventions, discounting, arbitrage. It's interest rates, bond yields, duration convexity, modeling non-parallel term structure shifts. All the 5 chapters are all together bracketed under fixed income, these 5 chapters. So these 5 chapters with interest rate, corporate bond and mortgage-backed securities. So these 8 chapters together is your fixed income subject, technically. Are you understanding? And in order to do this, you need time value of money. Otherwise, you can't do anything in this subject. So you can't say that time value of money is not in the syllabus and I will not study. And the remaining 3, as I have already mentioned, binomial tree, Black-Scholes, Merton and option, Greeks, that is a part of your option. So this completes your curriculum when you're looking at the 4 books. Are you having a sufficient understanding of the entire book? So in this book, if you see, there is a 5-chapter, 6-chapter chunk of fixed income. There is a 3-chapter chunk of options. The first part is 3 chapters with respect to VAR, and there are 3 or 4 theory chapters in between. Rating agency, country risk, credit risk, operational risk. So 4 theory easy chapters in between. But they're all important. You cannot, don't dare to miss on the theory chapter or not understand or not get into the depth or not practice. It's all the more important because there is more subjectivity when you're looking at the theory chapters. Tell me, everybody comfortable? Sure?